National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo video event, the Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.
And on today's show, business succession planning with industry consultant Ken Davis.
And now the host of the Business Insurance Zone, the whiz of the biz, insurance columnist Steve Savant.
We're broadcasting live from Fountain Hills, home of the largest fountain in America. I wish it was on right now, but it isn't. I guess we hit the wrong number. And of course, with me today is Ken Davis, CLU, CHFC, CFP, and CPA. Welcome to the show, Ken.
Hey, Stephen. Good to be back.
I've known Ken for almost a quarter of a century. Unbelievable.
Oh, God, that's scary. Thanks for putting it that way.
Hey, we're in the same study group. You know, we're just trying to be hanging with the guys that know what they're talking about. And of course, we're broadcasting live to a nationwide audience of financial advisors. And all this week, we've been talking about business succession planning. We're going to get into it today. Ken's got an article out called Business Succession Planning. Very colorful, I must say, Ken. That usually would be something I would do, but now you've entered the zone, and it's more than the business insurance zone. You're using colorful metaphors to describe our business now. I love that. Today, I want to talk about entity purchasing. You know, we're going to be talking about buy, sell, cross purchase, little touch on stock redemption, little touch on, I don't want to get too deep, wait and see trust. Now, you're going to say, Steve, everything you're talking about, wow, do you got anything on this? We have a complete package for business succession planning. It's a complete turnkey, not only educational piece, but this stuff, a lot of this stuff can be used with clients already pre-approved and cleared through compliance, most compliance. Again, always check in with your broker dealer just to make sure, but most of the stuff that we've touched is pretty much down the middle, already been touched and approved, so I just want to encourage you on that issue. Ken, when we talk about this, before we get into the entities, the different ones, I was kind of freaking out on one part of your article statement on your outline here.
Yeah.
Because I usually think of AMT as not an issue, but for C Corps that have a certain amount of adjusted gross income and own a life insurance policy inside the corp, if death had occurred, they could be subject to AMT, which life insurance in a C Corp is what? A preference item? Are you joking?
Yeah, and we've been talking about AGI so much on the other shows, I think it's kind of sunk into your brain, but there is no AGI on corporate.
Not our corporate side, sorry.
So we're talking assets and taxable income and stuff like that, and the formula is too complex to be going into here.
All right, so why?
But in the materials that we're sending.
But AMT.
AMT. Well, basically, it's interesting. You have your book accounting, you know, the generally accepted accounting principle, what we call GAAP affectionately, accounting, and then you have tax accounting, which is how the IRS views the world. And of course, normally from an IRS viewpoint, life insurance proceeds are tax-free, right?
Right.
So how can there be a problem? Well,
how can there be?
They look at the difference between the book numbers and they look at the actual cash proceeds, and they include that into a tax preference item. And there's a special form and a special formula for tax preference income for corporations. Now, the fact is, most companies aren't going to have a problem, but there are some large companies out there that are doing buy-sells, and AMT could be a problem. So while it isn't a major problem in most cases, just be aware that it's there and check and make sure that you're not going to have a problem. And that's why we need to have attorneys and accountants involved, because they're going to make sure that that's not an issue.
I can't remember the exact rule, and I don't know if it's 5 million or whatever, but whatever that number is, we have it in our book, and we actually have the one page, easy to understand, do the calculation, sit down with the CFO or the CPA of the firm, or I say, have Ken do it for you, get the guy in the line, he'll send it to him and say, I noticed one of our agents was in your office the other day, and he said you had buy-sell agreements owned by this corporation. He also told me you were a C Corp. You might be subject to the AMT. It may be qualified by the IRS as a preference item.
Right, and again, so many small businesses are LLCs or partnerships or sole proprietorships.
No problem there.
Generally, it's not a problem, although with Section 789 that we did on our show a few weeks ago, there has to be a C Corp involved to make that happen, and C Corps can be managed so that the tax issues are taken care of. So anyway, yeah, there can be an AMT issue, and one of the reasons to bring that up is because that's when you have the entity purchase the life insurance to purchase the shares of the person that's dying. So instead of what we're going to talk about in a minute, a cross purchase, this is where the company itself purchases the life insurance, receives the proceeds, and then purchases the shares from the deceased partner's estate.
Isn't that pretty traditional on the larger the corp? I mean, they're pretty much going to own the policy. They're going to buy it.
Well, that's generally seen as being first the most understandable, and people tend to buy things they understand. So there's a natural desire to do that, and it seems to be simpler. There are some complexities to cross-purchase, but the tax aspects are superior in most cases, and we'll show them how to get the best of both.
Now, when I think about cross-purchase, I like the idea, especially for smaller companies and so forth. But what happens when I mean, cross-purchase is Ken and I are partners. I own his contract, he owns mine. I'm the beneficiary of his, he's the beneficiary of mine. Our wives are paid by the proceeds and we're done.
That's right.
Pretty straight up.
Well, and let's go through the tax aspect, because from a sales standpoint, my experience is that business owners pay attention to tax issues and health insurance. I mean, that when they're talking to people like us, those are the two things that capture their attention. So let's look at the tax aspects of it. First of all, in a cross-purchase, partner A buys a policy on partner B. Partner B buys a policy on partner A. Okay, real simple. That's why they call it cross-purchase. And what happens is, in that case, we don't have an AMT problem. In that case, we have proceeds being received by A dies, B gets the money, and then B buys A shares out.
Done.
Okay? Well, the beauty of it is it's tax-free money, tax-free proceeds from the life policy. That remains what we all know. Okay? Number two, though, A's estate, A dies, A's estate gets a step-up in basis for estate tax purposes. So even though Joe and Susie built the business many years ago and put $5,000 of their own money and borrowed against their credit cards and loaned money to the company, they only have $5,000 in it, but yet, you know, Joe is buying out Susie's estate shares. She got in a car accident. Well, normally there'd be what? An income tax problem. I'm making a distinction. We get estate tax issues, we have income tax issues. In this particular case, it's an income tax potential issue. So her estate sells it for $1 million, only had technically a $5,000 basis, right? Well, because of estate taxes, the potential estate taxes don't have to actually be the tax. It gets a step up in basis to $1 million for income tax purposes. So when Susie's estate sells that stock for $1 million and receives the cash for $1 million, there is no income tax on that, as long as they didn't hold it long enough for it to appreciate beyond the date of death value. So on the day they die, it's $1 million, they sell it for $1 million, there is no income tax. No income tax on the life insurance, no income tax on the sale. This is a huge tax benefit, and one that you can play up in terms of, it's a big deal, it's important, but the agent should make sure the client understands this is great income tax money. The final thing is the estate tax. The estate will still have the value of that $1 million in the estate, and that may be subjected to estate taxes if the size of the estate is large enough. So for income tax purposes, the cross-purchase works great, no AMT. Here's another thing we didn't talk about on the entity side, is there's no step-in basis. When a C Corp, for instance, purchases shares from the deceased estate, the remaining shareholder gets no step-up in basis for that purchase. Okay, it's lost basically. On the other hand, on a cross-purchase, there is, when those shares are purchased for $1 million, you add $1 million to those shares for step-up in basis, so that if that partner then sells that company later on, you know, they may have saved just a whole bunch of money in taxes because of that step-up. And so that's why cross-purchase tend to be more favored than entity purchase.
So even if I only had two people, I might still want to go to cross-purchase just because of the tax treatment issue of step-up in basis.
Yeah.
And it seems to be a little cleaner, but what happens, again, what happens when I have multiple partners? Here's the bugaboo is, you know, I just saw this one come across my desk. I have 6 partners. The guy says, do a cross-purchase. And I said, what, a policy for everybody? Is that going to be a policy for every person?
No.
How can I get around all that? Because that's, most of the email I get is always like that. Hey, well, I have to do multiple policies, blah, blah, blah.
Yeah, and that's true. I mean, let's say you have 10 partners, and this is, I've got to tell you, I go to trivia night every 2 weeks, right? And I'm terrible at trivia. I know all this detail about the things we do, but the regular kind of stuff, you know, sports and celebrities and all that stuff, don't have a clue. But when we get into math types of stuff, that's where I shine. So here's a math situation. This is a statistics deal. When you get 10 partners, it's 10 times 9. 90 different policies that you'd need, because each partner, partner A has to have 9 other policies on the rest of the 9 partners. And then the second partner has to have 9 policies on the other 9 partners. So that's why it's 10 times 9. So if it's 3, it's 3 times 2. If it's 5, it's 5 times 4. So you take the total partners minus 1 and multiply those two numbers together. So 5 minus 1 is 4. 5 times 4 is 20. 10 minus 1 is 9. 10 times 9 is 90.
There's got to be a better way to do it.
Yeah, there's got to be a better way to do it. And that's where we get into either using some sort of a trust or a partnership to own it. And sometimes small businesses have separate entities already set up.
Now, and the IRS is okay with having a separate entity just to have the partnership from an insurance point of view?
Well, possibly. And this is where an attorney and accountant is important. Generally, there has to be a business purpose, and the commentators that I've seen have not been comfortable saying just set it up for insurance purposes. That may not be a sufficient business purpose. So make sure there's something like some sort of management contract or a leasing company or some other business activity that there's a reason, and there may already exist one of the several entities that does that, or the entity may be a partnership in the first place. Now, that gets us into a different area where we have the what we call a transfer for value rule, because you know, in our example, A dies, B gets the money and buys A out, but A owned a policy on B and B's still alive. What do you do with that policy? Well, there was some creative stuff with first to die policies years ago where you would then have the right to transfer it to a new partner and keep the cash value and not have the new fees and expenses that are attendant to an initial cash value life policy. But then the transfer for value kicks in, and if it isn't done right, and again, this is technical, we have it in our report with the details. I'm not going to try to go through all that today and bore our listeners silly, but the fact is that what is normally tax-free money from a life policy suddenly becomes taxable on an excessive basis. So we have to be, so setting up the entities and the cross-purchase and then transferring policies or creating new policies later on, actually creating new policies is cleaner. But having the right, a partnership can have its partners transfer, but regular corporations.
So the partnership or whatever entity, as long as it's a legal entity, we set that up, and now those policies are inside. We don't have to do this 5 times 4.
Well, that's the entity thing. The entity makes it easier, but then we don't have the tax benefit. So we want to stay with the cross-purchase. But we can now set up a partnership or a trust to own the policies, and it's one policy on each person.
And then you're done.
Then you're done.
Well, I like that better than 5 times 4. I like yours.
Yeah.
10 guys, 9 policies, 9 times 10, 90 policies.
Yeah.
And by the way, before we got into entities, we used to do it that way back in the day. You're listening to the Business Insurance Zone, the talk show that focuses on insurance in your practice. You can write us here at the show at thebiz@brokersalliance.com or just call toll-free 1-800-290-7226, extension 147. Ken and I will be right back after a word from our sponsor, Brokers Alliance, the premier provider of insurance products throughout the country.
Whether you're a professional planner pursuing a strategic partner or an insurance distributor seeking a national alliance, your business just went into overdrive. Now enter the largest resource of insurance products and services with unparalleled access to a worldwide audience of consumers through the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, who can take your company and launch it into the stratosphere of success. With countermeasures, the most comprehensive carrier intel in the industry, the MASH unit with field triage underwriting and the premium tolerance test, the life insurance financial evaluation, the most rigorous policy review, and Bravo high definition broadcasting with online social media. Your search just ended.
Well, welcome back to the Business Insurance Zone. I'm your host, Steve Savant, insurance columnist, financial color commentator, and on this show, interviewer extraordinaire. Before moving forward with any of the tactics and strategies that you hear on this show, especially this week, always check in with your CPA, your tax attorney, and if you're FINRA licensed, your broker-dealer compliance department. You can order any of the specials that we have on the show today just by calling us 1-800-290-7226, extension 147, and any questions or quotes you have on life insurance, annuities, DI, LTC, and group pension plans. It's not what I know, it's who I know, and that's why I have Ken Davis, CLU, CHFC, CFP, and CPA on the show. And Ken, we're talking about business succession planning, and in this segment, we're going to start breaking it down. We're going to touch a little bit more on cross-purchase before we leave that. I want to actually do a little heads up on stock redemption, and then this bizarre one that even though I've known it for 10 years, every time I bring it up to an agent on our phone or our producers, they always go, what is a wait-and-see trust? So let's just talk about a little bit about that, but let's get into cross-purchase just for a second. Now, if we have an entity that can hold these policies, I don't need multiple policies because that'd be a logistic nightmare having, as I said in the last segment, 90 versus 5, right? So let's say we have that and it's all set up. Now, we still have to have, even though we got the entity, even though the entity holds the policies in there, we still need documents to describe what happens at death. Is there also for disability, can I do that for the disability? Would it be multiple? Would it be in the same thing?
It's usually in the same document. The buy-sell agreement is a general
all-encompassing
term that covers both the disability and the death, and we talked quite a bit in one of the earlier sessions about the disability, but now it's going to be talking about death. And all that's really important. And one of the key areas, and I've talked to some of the most premier estate planning attorneys in the Phoenix area, and they say the cross-purchase agreements are some of the more ticklish. And a lot of it has to do with definitions of disability and valuations. And valuation's a big deal. I mentioned it in one of the other shows, but the IRS is always going to take the position the stock is worth the highest possible value. We know that privately held companies, it's not easy to determine what value is. There is no readily exchanged stock on an exchange. So trying to determine what fair market value is, when you hire an appraisal firm, they might have 3 different types of formulas to come to the same conclusion, and each industry is going to have different multiples and different kinds of factors. So finding a specialist that knows that. So IRS is going to push that to the limit. They're going to say, hey, out of this range from $500,000 to $1 million, we think it's worth $1 million.
Interesting to note that when people go to bank for bank loans, you know, they go to the bank, they're going to get, they want to make the company look as big as it can, strong as it can. They're putting stuff on the balance sheet, including I would say I'd call it anecdotal, like branding or good faith or, you know, goodwill, all these things.
Stuff.
So they're putting it all in from the bank point of view. I was in on a case where our producer, they tried to devalue the company for one purpose, but they were making it valuable for bank loans.
Well, sure, and the IRS is going to look at that. Just as we know the IRS is going to push it to the limit, the owner is going to do the low end of it. So, you know, they're both playing the same game. It's just they're going to take different viewpoints. So one of the cool things about buy-sells is that there is that tension. The person that survives wants to be able to buy the company for the least possible amount of money, right? Okay. And on the other hand,
I'm wondering, you know,
the family that dies wants the most money.
I know you mentioned this before, but I'm just curious now. You know, we talk about life insurance proceeds. You know, are they protected in a buy-sell, whether it's cross-purchase or entity? Are they protected from creditors?
Well,
the company creditors.
And that's a really good question. Is if it's an entity purchase, a stock redemption kind of situation, where the company purchased the life insurance policy on its owners, and when one of the owners dies, receives this cash into the company, they then turn around, they're supposed to buy the shares. Well, what happens if the company was leveraged to the hilt? Now the bankers see that everything's falling apart, and there may be some covenants and restrictions on the loan that certain events will trigger the repayment of the loan. Well,
so it could get called.
It could get called, or they may not suddenly be meeting their financial ratios and stuff like that, and they say, hey, I'm sorry, but you owe us the money. And we noticed that you just got all this money from this life insurance proceeds. I know you're intending to buy out the partner, but we want the cash. And they come in and legally tie it down and grab the money. Then there's no money to purchase out purchase the shares of the deceased partner. So that's in an entity purchase. When we have the cross purchase, where partner A buys from B and B buys from A, Well, those life insurance proceeds are golden. Creditors can't go out and stop that money from going to the beneficiary. That's a huge no-no. And that's why people can be very comfortable with life insurance proceeds is the insurance companies will only pay that money to the beneficiaries. So if B dies and A gets the money, A's going to get the money. The estate's going to have that cash and then can turn around and purchase those shares. There may be some personal guarantees that the corporation may try to come after them, but generally, from the reading that I've done, the cross-purchase actually works better. But that also means...
So it could be an insulation issue.
Right. Okay. And we talked about earlier is having a key man insurance. That would have taken care of this issue, is if they had both. They had the cross-purchase, but then bought a separate entity-owned key man insurance on that partner.
And I think
to have that cash to pay off all those creditors, we extinguish those. And in both cases, if the budget only will allow, do the term insurance, a 10-year, 15, 20-year. You told me this years ago, I never forgot it. You said, ask the partners, how long do you think you're going to be in business together? Right. And of course, they're going to tease each other. Say, I don't want to be with this guy more than another 10 years. I mean, I've already been with him 20. I mean, I want to beat myself up. I'm a masochist, right? And they'll have a little fun with it. And, but yeah, 10, 15, 20-year term is cheap, right? So you can do the buy-sell that way, and you can do the key man, get rid of the creditor problems, get rid of the tax problems, lock in the value. I mean, this makes so much sense from a tax perspective, from a cost perspective, from a tragedy standpoint, and as you were pointing out in our earlier shows, you got employees that depend on this business. You have families that depend on the business. You've got bankers that depend on the business. All of this can so easily, this tragedy of all this falling apart and affecting so many lives. You know, you talked about divorce, and I meant to bring this up. One of my clients has 95 employees. He's the sole owner, so we weren't doing buy-sell. He's going through a divorce. You know what the asset is that he has cash to purchase the shares of this company from his wife? Life insurance. This guy is insured up to the hilt. This particular insurance agent is one of his best friends, and he's got insurance for everything. And he's sitting there and saying, the stock market's down, my business is down, I'm getting divorced, the world is falling apart. The one asset he had left that made him whole and allowed him to continue the business and take care of the wife is cash inside the life insurance policies.
Wow. When I think about the distinction between the power of the leverage of life insurance to take care of all these things we're talking about so you don't sweat the bullets on this. And I like that distinction. Now, we talked about it 2 days ago, but you know, I'm starting to think about it more and more. I think most of our producers, like me, I probably think, wow, I think every time I think of key man, I think of the employers have somebody that's key to them. But I never think of them being the key employee.
They're key employees. And by the way, there is some materials in the report that's free that they can order that talks about how you can value what an employee is worth. You know, lost revenues, costs, different kinds of things. And at the same time, we can put life insurance in place to pay the families of these. And that's where we can start getting into some cash value types of policies.
Well, I noticed that Brokers Alliance has a big chip on me, so if I go down there, they're going to be celebrating all the way to my funeral.
No, don't get too big ahead there, Steve.
Okay, what can I say? Hey, let's talk about stock redemption. Just a little bit about that. I want to touch on it. I want to spend a lot of time. We have a whole brief on this, but if I don't say it, I'm going to have somebody say, Steve, you left out stock redemption.
Well, you know, entity purchase really is a stock redemption kind of a thing, and it applies to both corporations, partnerships, LLCs, sub-S, et cetera, and there are some different tax distinctions, and that's why the report's important. But if you have a C Corp and you have a stock redemption, we talked in one of the other shows about the fact that you have a C Corp that's taxed as an entity, whereas a partnership is a SIV that just flows down to the partners, and an S Corp flows down to the partners, and of course a sole proprietorship does. But a C Corp is a separate taxable entity. And so you have the potential of a double taxation. The company gets taxed. They then, to get the earnings to the shareholders, have to pay a dividend. And then, of course, the shareholders pay taxes on the dividend. So in this particular case, the money comes if the C Corp buys the life insurance, does a stock redemption, the company's buying out the deceased partners. The IRS may choose to treat that as a dividend and not a purchase. And so, you know, ordinary income instead of capital gain issues. And so...
Try to pay twice, really.
Well, yeah, and so that becomes an issue. So, and you might say, well, how can that happen? Well, the code section says if if the seller totally divests themselves of ownership, then they're okay. But what's weird is they have these attribution rules that say that the owner or the kids own the father's shares and the wife owns the shares and whatever, so they may not technically be totally devoid of the shares.
So they could say they may be incident of ownership of some sort, where they'd have to, they've already been paying taxes on the corporate side, now they're going to pay taxes because they treat it as a dividend. Wow.
That's right. So they get the money and the purchase is treated as a dividend and not a purchase, and that's the crux of it. And that's another reason why entity ownership, or in this case, stock redemption and a C Corp, can become problematical. So AMT, no step up in basis, and the potential for dividend treatment.
We have all this again in our document, and this is the kind of thing I like to go down and ask my client, a C Corp client, AMT issues, things of this nature, go down the line, dividends, all these things that we can circumvent and actually put in place defensive mechanisms using planning, using life insurance, DI, all these things that we're talking about. Tomorrow we're going to touch on wait and see trust. I mean, I keep thinking, wow, can we invent something else? It's been around for a good long time, but it's making a comeback, and I want Ken to address it. You can watch our show on all our shows in HD 1080p right on our website, www.brokersalliance.com. Go out there, just hit the on-demand section, just pull it on down. And remember, we're on all our social networks, Vimeo, YouTube, Facebook, LinkedIn, of course, where I tweet, Twitter. I'm Steve Savant. You've been listening to the Business Insurance Zone. That's the buzz on the biz for today. Get in the zone, the Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. Need insurance guidance? Call Brokers Alliance. Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.